Wow, I think we all expected to believe that CPI data was rigged, but I don't think we thought on a month-over-month basis the Bureau of Labor Statistics, the government agency responsible for putting together U.S. consumer prices, also known as the CPI index, I don't think that they would usually be so blatant as to send an email and basically go, hey, for everybody looking for the weird thing that happened in January, you're right, we screwed up, oh well, maybe we'll make some changes, but for now, that's all we got for you. Yeah, that's literally what just happened. So let's explain this. I'm going to show you some screenshots here. This is a big deal. Quick reminder, if you haven't yet gotten into the new information on househack, my real estate startup, big things happening. Go to househack.com/2024 and you'll see the warrants that have been called, and you'll also see the new fundraise we have going on that it has a deadline to it. All the information at househack.com/2024 or link down below. Okay, so let's get into this. So the big issue that they had here had to do with US CPI being heavily tilted towards what's known as owner's equivalent rent and a large adjustment that occurred between December and January. Now, let me first explain a little bit about how stupid this thing is. Owner's equivalent rent is basically a measure of rent that lags by about 12 to 18 months. The reason is you basically got bureaucrats going, hey, owner, what do you think you can rent your house out for? Oh, well, my neighbor's renting their house out for $2,800. Great. So, an example, a neighbor with a similar house, whatever. That's just a rudimentary example. I'm purposely oversimplifying this. So let's say the rent was $2,800. Then we get a bunch of inflation that happened after the insane money printing we did of the 2020-2021 era. Well, so you call the owner in 2021, hey, what's your rent? Oh, I don't know, still $2,800. It really takes about a year for them to be like, man, they just rented their place for $3,500 over there. That's a 25% increase. Boom. That's where you get the skyrocketing lagged effect of inflation basically really hitting us by storm in the summer, like June, July of 2022, and then obviously throughout 2022 and 2023. Now, let's say that today the market rent has actually gone from $3,500 down to $3,395. Well, does that owner go, hey, what's the market rent now? What's going on? What's the market rent? Oh, I don't know. It's still rented for $3,500, the next door neighbor. Okay, so what good does that do you? Is that tenant going to pick up and move to find something else to save $100 a month? Maybe, but maybe not, because it's probably going to cost more than $1,200 their annual savings to actually pack their bags and move. It's a pain in the butt. So now you get people locked in at these higher rents, and it is really sticky to get rents to come down. A lot of landlords, instead of actually lowering rents, will just not raise rents. So when rents go up, they raise rents like crazy. When rents fall, they just stop raising rents. So you kind of get stuck. Now, that's not to say that isn't the actual cost of what people have to pay in rent. It is. But here's the problem. It's not the actual market rent. You've got this skew built in, the skew between what somebody's currently paying and what somebody should be paying. This is called gain or loss to lease. That is just a fancy phrase. You don't really have to know what that means. But the point is, currently, we're seeing a lot of influx of rental supply. At househack, for example, every single market we're in and we're competing for properties in, whether they're single family or multifamily, we're going in with the assumption that what rents were 6 months ago, we're going to discount. So we're underwriting deals at a lower rent because we expect to have to lower rents to be able to maintain full occupancy. We like buildings operating at 100% occupancy. Anyway, this has been one of the reasons we've seen such a divergence. This is one of the reasons, which you could see this chart at ehack.com, of course. This is one of the reasons you can see that owner's equivalent rents in January skyrocketed here for no reason, and they've kind of been sticky around this 4 to 5, 40 or 50 basis point per month levels. Been sticky around here and actually increasing. And the real problem with this is that rents are actually lowering. But what did the good old BLS just tell us? Well, the BLS just released this email. They said the following. Good afternoon, super users. The waits for single-family detached homes increased materially from December to January 2024. Oh, wait, wait a minute, multifamily doesn't have the 30-year fixed rate mortgage lock-in effect, so that actually means you have less price discovery in single family than in multifamily. In English, prices for multifamily rents are going to fall more quickly than that of single family rents because of that disparity. We know, we deal with both at househack. Okay, well, that's a little problematic because if now you're saying the one that's not responding to the market, you're gonna weigh more heavily, well, you're just skewing the data. You're literally messing up the data. And what's their excuse for this? All of you searching for the source of the divergence have found it. No additional information related to this question will be disseminated. We do not do diagnostic analysis of microdata. In other words, the Bureau of Labor Statistics is straight up, full-on cavalier here. Hey, yeah, we don't really have a reason why we just increased or tweaked up the data for single-family homes. I don't even know what would possess somebody to make an adjustment in the weighting between singles and multi, especially when singles should be weighted lower because you're getting less of a market read because there's less turnover in single-family. It doesn't even freaking make sense. But all the explanation we're going to get as Americans whose livelihoods are affected by inflation through higher interest rates, credit card rates, car rates, loan rates, you name it, business loans, what a freaking pain in the freaking ass, okay? All of us who have to deal with this crap, this is all we get. Yeah, we changed it and we're not really gonna speculate on why. Okay, how about actually trying to do the job of an economist and actually look at what's actually going on in markets? How about that? Here's Bank of America Shelter Index. They show you where owner's equivalent rent is, up here, the red line. And for this one, you have to use the right side. So you're sitting at, what is that, about 6-ish% over there on the owner's equivalent rent right side. And then we pull over to the left side over here for the others. The highest read is about Zillow, sitting about maybe 4.2%. But if you actually look at apartment list, you're down at closer for apartment list. Boy, at apartment list, you're actually sitting at about -1%. And then when you look at new tenant repeat index year over year, you're at -5%. This is a massive, massive disparity in what the Bureau of Labor Statistics is using for a measure of inflation and reality. This is insane. Now, what are the implications of this? Okay, well, this creates some problems. First of all, somebody else at the Bureau of Labor Statistics suggests that they're going to look into the data and they may have some additional communication in the future. That's because a lot of people are pissed off about this sort of rigging that's going on here. It's quite frankly disgusting. But beyond that, the question is it good news if single family gets weighed higher going forward? No, it's bad. It literally means even if inflation is not staying higher for longer, it's going to seem like it's staying higher for longer. So it's bad. It's fugazi. It's BS. Now we get PCE data, but PCE data, which the Fed prefers, is like based heavily on the CPI reads. So it's a complete disaster. Now, another thing you could do is you could jump on over here and understand what happened in January. So we got a core inflation read in January of 0.39%. That was made up by 0.2% housing, heavily influenced by this screw up by the Bureau of Labor Statistics, 0.14% for Medicare services, vehicle insurance, and vet services. Worth noting that health care-related services usually have an unseasonably large increase in January. I guess that would be a seasonally large. Anyway, usually they have a big jump in January, okay? And sometimes the adjustments they make don't really accurately capture that. And vehicle insurance is another sort of lagging. Any kind of insurance is very lagging in terms of how it is affected by inflation because it takes a while for costs to go up. Then the insurance company is like, oh my gosh, costs went up. And then it takes a while for them to actually charge people higher insurance premiums to make up for that. So really, really lagging kind of data that's still hot or just straight up rig data. Goods deflation is literally at -0.5% for the month. Keep in mind, small typo here, this, I'm gonna change, it's 0.6% for negative goods inflation. That way this adds up correctly. But anyway, the point is, yes, goods deflation is occurring. Of course, we know that, and it's been occurring for a while. We did have a jump in those core services, heavily driven by these three items: Medicare services, vehicle insurance, and vet services. And yes, housing was adjusted up. But the explanation we got for housing moving up was, yeah, we changed it, deal with it. And that is probably the most concerning part, is that the explanation we get is, yeah, we changed it, deal with it. There's no logic to it. There's no explanation to it. It's just basically rigging the data. I don't know, maybe the person who's hitting enter on this has certain political persuasion and wants certain things. I don't know. Maybe they like high money market rates, which then again, in fairness, who doesn't? Now we'll get PCE numbers tomorrow. PCE is expected to come in month over month 0.3, deflator 2.4. 0.4 on the month over month and year over year at 2.8. If you have not already been watching me in the morning market open live streams, link down below, you'll see the link to the Meet Kevin Market live stream channel. I'm live every single day the market is open at 5:25 a.m. California time, providing you insight, value, trade ideas, everything that we can talk about regarding the market for free at that channel. Go check it out. Thank you so much for watching, and we'll see you in the next one. Goodbye and good luck.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate an actively managed ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than househack, nor am I presently acting as a market maker.